Iran just lit the fuse. And right now, while you're sitting there watching missiles on your phone at midnight, refreshing your portfolio and feeling your stomach turn into a knot, the smartest money in the world is quietly doing the exact opposite of what your gut is screaming at you to do. I need you to really hear this part, because it's going to save you a lot of money, or it's going to cost you a lot of money, and there is no comfortable middle ground here. Every single time there's a war, a shock, a crisis, and I mean every single time, 99% of people do one of two things. They panic and they sell everything at the bottom, or they get greedy and they chase oil stocks and defense stocks right at the top. Both of those feel like smart moves at the moment. Both of those are exactly how regular, hardworking people lose their savings. I've built businesses from nothing. I've sold companies for real money. I've sat through crashes. I've sat through recoveries. And I'm telling you straight, this Iran situation is not some random burst of chaos. You can't understand. It's a pattern. It's the same pattern that's played out again and again, decade after decade. And by the time I'm done talking here, you are going to know exactly what phase we're in right now, where the real money is actually flowing while you're not looking, and how to make sure you're not the guy left holding the bag when the music stops. Before I get into the meat of this, one quick thing. This video is dense. There's a lot packed into it. Because I don't do fluff. I don't pad things out just to keep you watching longer. So if you're serious about actually using what I'm about to give you, instead of nodding along and forgetting all of it, in 10 minutes, hit subscribe right now. I'm not going to pretend this is some throwaway task just to pad my numbers. What I'm walking you through in the next half hour is stuff that hedge funds and family offices pay real consultants real money to explain to them. You're getting it for free because I genuinely believe financial literacy should not be locked up behind some paywall for people who are already rich. So subscribe, stick with me, and let's get into it. Here's the first thing you need to burn into your brain, and it's the thing almost nobody bothers explaining to regular people. Markets don't just randomly react to war. They move through predictable phases. And if you don't know those phases, you are trading completely blind. No different than playing poker, without knowing what beats what. Phase 1 is the shock. That's exactly where we are right now with Iran. It's loud. It's emotional. Oil spikes hard. The fear index goes crazy, and everybody's phone is buzzing with the same terrifying headline at the same time. Here's the part nobody tells you about Phase 1, though. It's almost always a head fake. I watched this exact movie play out during the Gulf War. I watched it during the invasion of Iraq. I watched it when Russia invaded Ukraine, and I've watched it in every single Middle East flare-up going back decades. The initial move, that big scary spike everybody's staring at, it's driven by fear and by algorithms selling, because other algorithms are selling. It is not driven by anybody sitting down calmly and doing the actual math on what any of this means 6 months or a year from now. And here's something wild about this particular shock. Even gold dipped a little in the first few days. Gold is supposed to be the ultimate safe haven, the thing everybody runs to when the world looks scary. But some big players had to sell gold just to raise cash to cover other positions elsewhere. That, right there, is your proof that Phase 1 isn't about logic at all. It's about pure panic. And panic is not a strategy. Panic is an emotion. And in 30 years of watching money move around, I have never once seen a raw emotion make anybody rich consistently. Not once. So what do you actually do during Phase 1? You do nothing. I mean that literally. You don't sell everything because you're scared. And you sure as hell don't jump headfirst into oil stocks or defense stocks because you saw one scary headline on your phone. Both of those are just gambling, wearing a nice suit. The rule here is dead simple. Don't chase the spike, and don't panic. Sell into it either. And if you're feeling that urge right now, trust me, I get it completely. It is a totally rational feeling. Your brain is wired over hundreds of thousands of years to spot danger and run from it as fast as possible. That instinct is literally why your ancestors survived long enough for you to exist today. The problem is that the exact same survival instinct is what gets you completely wrecked in the stock market. Because markets panic first and figure things out later. almost every single time. Without exception, the people who actually win in moments like this aren't the ones who feel zero fear. They're the ones who built a system that's stronger than their fear before the crisis ever hit. That's the entire secret. That's the whole game right there. Let me give you a real example. So this isn't just theory floating around in the air. Go back and look at what happened with oil and energy stocks months before this current Iran situation even hit the headlines. Smart money was already quietly building positions in energy names well before any of this became the top story on every channel. Nobody had some crystal ball predicting a war. What they had was a read on where prices were trending, where insiders were buying, and where the fundamentals were pointing, completely separate from any headline. That's the entire difference between reacting to news and reading the market itself. The stock market, if you actually pay attention to it, tells you almost everything you need to know without you having to understand a single thing about geopolitics. I don't own a television. I haven't in years. I don't sit around watching cable news predict the next crisis. I watch the prices. The prices tell me where the real money is moving, and I don't need to know exactly why to act on it responsibly. That's not luck, and it's not magic. It's just paying attention to the right thing instead of the loudest thing. Now let's talk about what happens right after the shock wears off, because this is where things get really interesting, and honestly, this is where the real money gets made or lost. Phase 2. I call this the repricing phase. This is when the initial panic starts to fade, and the market stops asking how scary does this look on TV and starts asking a much smarter, much more boring question, which is, does this actually change anything real? Does it change inflation long term? Does it change what the Federal Reserve is going to do with interest rates over the next year? Is the supply line actually broken for months on end, or is this just a few days of noise that fixes itself? This is the quiet phase. This is where the big institutions, the guys running billions of dollars with deep pockets and research teams, calmly and quietly reposition their money while everybody else is still glued to cable news, refreshing their brokerage app every 5 seconds like it's going to change anything. And I want you to think hard about what's actually happening in the real data right now. Because I'm not guessing here. I'm not telling you some theory I made up in my head. Corporate insider buying, meaning the actual executives and founders who run these companies, buying their own stock with their own personal money, just hit one of the lowest levels we've seen in years. Barely 1 out of every 3 big public companies had even a single insider step up and buy shares. Instead, insiders were busy selling into the rally, while everybody else was buying. Analysts actually have a name for what's happening right now. They call it the Great Handoff. The people who actually built these companies, who see the real internal numbers before the rest of us ever do, are quietly handing their most expensive, most crowded, most hyped-up tech stocks over to regular retail investors who are buying in at nearly double the normal historical pace. Let me put that in plain, everyday English for you. Picture a game of musical chairs. Retail investors, that's most of you watching this, are out there dancing faster and faster, having a great time, cheering, buying tech stocks hand over fist. Meanwhile, the professionals, the insiders, are standing quietly right next to the one open chair, patiently waiting for the music to stop. That's not some conspiracy theory I'm cooking up for views. That's literally what the insider buying and selling data shows us right now, and it's almost identical to what happened right before previous downturns too. Now here's where I want to connect some dots that almost nobody is connecting out loud for you. And I promise you this isn't some tinfoil hat theory, this is just following the dominoes one at a time. Plain and simple. Conflict breaking out in the Middle East pushes oil prices up. That's not some grand conspiracy, that's just basic geography. A huge chunk of the world's oil sits in that region. Oil goes up. And when oil goes up, inflation goes up right along with it. When inflation goes up, the Federal Reserve can't cut interest rates the way everybody desperately wants them to, so rates stay higher for longer than anybody's happy about. Now, here's the part that actually matters most. The part that connects straight to your wallet. Higher inflation does something very specific and honestly pretty convenient if you happen to owe an absolutely enormous pile of debt. And our government owes an absolutely enormous pile of debt. Inflation quietly shrinks the real size of that debt over time, without a single politician having to admit to a single dollar of default. I know that sounds like I'm making it up. So let me give you the actual history, because this exact thing has happened before, and it played out almost identically. After World War II ended, the national debt in this country was about 106% of our entire economy. That is a genuinely terrifying number on paper. One generation later, that number was all the way down to 23%. Did we pay it all off? No. Not a single extra dollar disappeared through some giant payment plan. What actually happened is that low interest rates combined with hot inflation quietly shrank the real value of that debt over time. Economists have a fancy technical name for this. They call it financial repression. And honestly, it's a pretty accurate name, because that's exactly what it feels like when you're sitting on the wrong side of it. Your $100 slowly starts feeling like it's worth 70, and then like 50, and it just keeps sliding from there. The flip side of that same coin is that your cash, if you're just sitting on a pile of it in a savings account thinking you're being safe, is getting quietly eaten away the entire time this is happening, whether you notice it or not. There's a newer piece to this whole puzzle too, and honestly, it's kind of brilliant once you strip all the emotion out of it and just look at the mechanics. There's new legislation now that requires stable coins, those digital dollar tokens everybody's suddenly talking about, to be backed directly by US government debt. What that does functionally is create a brand new giant built-in buyer for all that government debt that keeps getting issued year after year. One single stablecoin company right now is already among the top 20 holders of US government debt on the entire planet. Sit with that for a second. So you've got conflict pushing oil prices up, oil pushing inflation up, inflation quietly letting the government inflate away its own debt over time. And now, on top of all that, you've got a brand new mechanical buyer soaking up even more of that debt at the exact same time. Iran isn't the cause of all of this. Machinery. Iran is the accelerant. It's speeding up an engine that was already running long before any of this started. I'm not telling you any of this to scare you or to sell you on some wild conspiracy podcast nonsense. I'm telling you this because understanding how the machine actually works is how you stop being a passenger getting thrown around in the back seat and start being somebody who actually knows what's probably coming next. So now, let's get into the part you actually clicked on this video for, which is what you personally do with all of this information. Here's my entire investing philosophy, boiled down into 3 simple words. Tilt, don't gamble. You lean gently toward what's probable. You never bet the whole farm on one single guess, one headline, one hot tip you saw from some stranger online. Let me walk you through 5 specific places I'd personally be tilting toward right now, and I want you to actually write these down. Number 1, energy. But not the way most people think about it. Buying oil itself, right after a spike, is usually a terrible trade, because historically that initial pop fades within about 6 months, sometimes faster. If you want real energy exposure, look at the infrastructure side of the business instead. The pipelines, the storage terminals, the companies that get paid a fee no matter who's actually pumping the oil out of the ground. Think of them as toll collectors on a highway. They get paid regardless of which car is driving by. Number 2, defense. And this one is not some one-week news pop that fades by Friday. This is a genuine multi-year story. Countries across NATO are lifting their defense spending targets dramatically higher than they've been in decades, and an increasingly large chunk of that new spending is heading straight toward drones and unmanned, AI-driven systems. If you're putting money into this theme, spread it across a handful of names instead of marrying yourself to one single defense contractor, because contracts get won and lost all the time in that world. Number 3, gold and silver. Central banks all over the world are hoarding gold right now at the fastest pace we've seen in decades because they're genuinely nervous about the dollar and about their own reserves potentially getting frozen someday. This is not a day trade for you to jump in and out of this week. This is something you patiently accumulate over years, maybe even over decades, not days. Number 4, quality, meaning businesses with actual real pricing power. Companies that can raise their prices and still keep their customers coming back for more. That sounds fantastic in theory, until the customer finally hits their limit and says no more. We're already watching some of these companies get forced to quietly walk back price hikes after pushing their luck a little too far. So you want a company with genuine, durable pricing power, not one that already burned through all its customer goodwill trying to squeeze out one more quarter of profit. And number 5, and this is the one most people completely ignore, know the losers just as well as you know the winners. Higher interest rates for longer periods of time genuinely hurt anything that runs on heavy borrowed money and depends on paying out steady dividends. Think utilities. Think a lot of traditional real estate. Knowing exactly what to stay away from is just as valuable to your bank account as knowing what to actually buy. And look, I'm not telling you to go bet the farm on any single one of these 5 ideas either. That would completely contradict everything I just said about tilting instead of gambling. The whole point is that you spread your attention and your money across a handful of these themes, and you size each position so that if you're wrong about one of them, and you will be wrong sometimes, everybody is, it doesn't take you out of the game entirely. I've built and run real businesses. I've sat on plenty of sides of plenty of deals, and the operators who last the longest aren't the ones who are right every single time. Nobody is right every single time. Not me. Not the biggest hedge fund manager you can name. The ones who last are the ones who never let one wrong call turn into a knockout punch. That's the entire game. Staying in it long enough for your good decisions to compound. Now here's the part I personally care about the most out of this entire video. And it happens to be the single least exciting thing I'm going to tell you today. But it's the thing that actually keeps you in this game long enough to eventually win it. Risk management. Position sizing. Never betting so big on one single idea, no matter how confident you feel about it. That one bad call can wipe out everything you've built. I've started companies. I've lost real money on things I was 100% convinced were slam dunks. And every single time I got genuinely hurt, it was never because my original idea was wrong. It was because I bet too much of my chips on being right. You do not need to become some kind of genius on Middle Eastern geopolitics or oil shipping routes or drone warfare to make good financial decisions here. I am definitely not an expert in any of that stuff, and I'm not pretending to be one for you today. What you actually need is a system, a set of rules you follow, no matter whether you're feeling scared or feeling greedy that particular day. Because your raw emotions make an absolutely terrible trading partner over any real stretch of time. The news is not your friend in any of this. The news exists to keep your eyeballs glued to the screen, not to make you a single extra dollar. If you're feeling that pit in your stomach right now, watching all these headlines scroll by, that is completely normal. That's your brain doing exactly what it evolved over thousands of years to do. But the market does not reward the person who manages to feel the least amount of fear. It rewards the person who built a plan in advance that doesn't care how they happen to feel on any given Tuesday. So let's bring this whole thing all the way home for you. 3 phases: shock, repricing, and rotation. Don't waste your energy trying to predict the next scary headline. Instead, follow where the real money is actually moving underneath all the noise. Tilt gently toward what's probable, and never, ever gamble the whole thing away on one single bet you saw trending online. And whatever else you take from this video, do not let fear be the thing making your financial decisions for you, because fear is expensive. It's genuinely exhausting to live with, and it steals your sleep for absolutely no good reason at the end of the day. So here's my actual challenge to you, and I want you to do this before you touch anything else in your portfolio this week. Go pull up your 3 biggest positions right now, and honestly ask yourself, would I still be holding this exact stock if there was zero war in the headlines today? If your honest answer is no, that tells you everything you need to know about whether you were genuinely investing or just quietly gambling on a scary headline dressed up to look like a strategy. Drop a comment right now and tell me which one of these 5 tilts actually makes the most sense to you for where we are today. I promise you I read every single one of them myself. And if this video actually changed how you're looking at what's happening in the world right now, do me a favor and share it with somebody you know who's been doom scrolling this stuff at 2 in the morning and losing sleep over it. Because calm, informed people consistently make better decisions with their money than scared, reactive ones every single time. No exceptions. I'll see you in the next one.